A very common question I get from YouTube subscribers, and especially people in our community, is, should I invest in ETFs or stocks? And I always say they're not mutually exclusive. You don't do one or the other. My belief, truly, is that you start with ETFs. Then, as you get a process and, more importantly, you're able to handle your emotions, you've switched to stocks. But it's very important to understand why you would pick one over the other, and then a combination of both as time goes on. So let's first start off with stocks versus ETFs. Okay, so what are the differences? Guys, when you buy a stock, you're buying a piece of a business. This is not embraced by as many people as should. You're not buying a ticker going up and down. You're buying an ownership stake in a company. Just like if your neighbor came to you and said, hey, I have a mechanic shop and I have 10 shares. Would you like to buy 1 share? You now own 10% of that mechanic shop. That's no different than here. The only difference is there's billions of shares out there for every company. So when you buy one, it doesn't feel like much. But the point is you're still buying a piece of a business. When you buy an ETF, you're buying pieces, plural, of lots of businesses. So what you're doing here is you're diversifying. Now, the great thing about ETFs is you can diversify into different categories, into different indexes and countries, etc. So it gives you a lot more diversification. And I run out of room. So diversification, okay? This is more concentrated. Now, the great news is when you buy stocks, if you buy 20 to 30 stocks, you get your own ETF essentially. But more importantly, you have to have that process for buying stocks. I encourage that immensely. With ETFs, I believe in something called dollar cost averaging. And here's why you need a dollar cost average, okay? And I've shown this chart many, many times on this channel. So if you're new to it, this is where stocks go over time. But this is where prices of those stocks go over time. This 45-degree line is their values. This line here, curvy line, is Mr. Market. Excited and euphoric, depressed and sad. The question you have to ask yourself is, what's your goal here? You want to make this line. So what do? You dollar cost average in an ETF. You keep buying no matter what, every single time, no matter news is good or bad. You blindly do it. And guess what happens? Over time, you average this. And for those of you who have the balls to do this, when valuations are low, if you're able to increase, you're actually going to sit there and make this kind of return. But it takes a lot more emotional control to be able to do that. Whether you're buying in stocks or ETFs, you still have to be able to handle your emotions, but it's all the more important with stocks. Why? Because Mr. Market's fickle. And we've seen big companies fall 80% in a matter of 6, 8, 9 months. It's hard to see the stock market fall 80% in that short period of time. During COVID, we saw 1 month in which the S&P 500 fell 40%, which was absurd. But it was there, and it was scary. Why? The world felt like it was going to shut down. But again, if you buy an ETF and you do it like this, how does your money go to zero? Your money goes to zero if and only if this happens. The entire world goes to zero. Now, obviously, it depends. If you're buying like crypto ETFs, if crypto goes to zero, boom. So it depends on the ETF you're buying. But whatever's underlying that ETF has to go to zero before you go to zero. So if you buy VOO or SPY, the biggest S&P 500 ETFs, the entire US economy would have to go to zero for your money to go to zero. What are the chances of that? But with an individual stock, it can go to zero all the time. There are many companies that have gone to zero pretty close. Let's go Workhorse, that got pretty close. Tattooed Chef, that got pretty close. At one point, Carvana, I think it's, I don't know what Carvana's ticker is. It didn't go, now it's rebounded. But these companies got very close to zero. Blockbuster went to zero. So that's the difference with that. When you buy an individual stock, you have that risk. So for me personally, when I buy individual stocks, even though I'm very picky, I still like to diversify. Once you get past the point of 15 or 20 stocks, you've basically taken out, as long as they're diversified and good, you've taken out all market risk. You're essentially your own mutual fund or ETF. But it's so important to understand that stocks take more work because you have to watch those stocks. When you buy an ETF, somebody else is watching it for you. When a company enters that ETF category and other ones get removed, they do it automatically. You don't have to do anything. That's the benefit of ETFs. You have an opportunity to beat the market doing both individual stocks and ETFs. You might wonder, how am I going to beat the market with ETFs? What I said before, this line's like this. If you have the gumption to be able to buy more when stocks are undervalued. Well, how do you know they're undervalued? Great question. Thought you would never ask. Well, guys, this is what I do for our community all the time. Every week, I update my stock market to GDP ratio. I do this going back to 1928 or 1929. Warren Buffett says that at any given time, this is the most reliable indicator of where stocks are valued. And right now, guys, we're 94% overvalued. That's high. The best ever was 65% undervalued in August of 1982. And from there, stocks without dividends made 14% returns. Here, projected returns are not good. Projected returns, not including dividends, are negative right now. Does that mean you should get out and say, no, because we don't know where things are going to go. It's been bad for a long time. Going back to 2021, we were 100% overvalued. And look, back then, we had 4,500 S&P, today 5,000. Why? Because GDP got a lot better. Inflation helped that. That was a big key there. And guys, even more important, these are all the things that have happened going back to 1950 something. All these negative things have happened. It's so easy to get bogged down in the negative news. When you hear that negativity out there, it gets your emotions. I don't know where you feel anxiety. I feel it in my stomach. I get cringing stomach. I go, oh my God, something's wrong. Some people feel it in their neck. That's the hard part about investing in ETFs or stocks, but it's especially harder in stocks. Why? Because you can see your stock fall very, very quickly. Very quickly. A stock falling 20, 30% in a matter of a couple months is not unheard of. Every major company has done that very quickly. So you have to be able to emotionally ride out all this bad news. Look at all this bad news. JFK killed, Vietnam War, Cuban Missile Crisis, Nixon resigns, stagflation, Black Monday, Soviet Union collapse, 18% mortgage rates, saving and loan crisis, Y2K, Iraq War, 2, Gulf War 1, dot-com bubble, September 11th, housing crisis, COVID, Brexit. It goes on and on. By the way, this is 1% of all the bad news, maybe not even 1%. That's what's key about investing. You buy based on fundamentals and you hold and build your wealth based on being able to manage your emotions, whether it's stocks or ETFs. Now, when it comes to ETFs, you know what people want to say? No, I want to buy a mutual fund. So what's the difference? Well, a mutual fund is high costs, low returns. Now, that's not their intention, but it's also actively managed. So the second you get actively managed, what are you getting? You're getting human emotion. The most important part about investing is to eliminate as much emotion as possible. These managers who manage these mutual funds, they love getting their fees, and their goal is to just stay right around where the market is. They're not trying to, because guess what? The best performing mutual funds in history, at some point in a 10-year period, they've been in the bottom 10% of returns. If you're in the bottom 10% of returns, if you see one of your mutual funds doing that, what are you doing? You're probably selling it. That's what's hard. Because in order to be an outperformance manager, you got to look stupid from time to time. And that's so incredibly difficult for anybody to do, even those Harvard MBAs who manage these mutual funds. Now, it's also costly, high costs. Why is that? Well, mutual fund on average is 0.5 to 1.5% per year. Let's say it's an average of 1% to be easy. What's ETFs? Well, SPY is 0.09% versus 1 full percent. That's incredible. 1/10 the cost. VOO, even lower, 0.03%. So you might sit there and say, yeah, but Paul, it's only 1% difference. Well, luckily your Uncle Paul has some information for you. Part of our software is Retirement Calculator. Now, I created this because I thought all the retirement calculators out there were garbage, because all it did was say, hey, how much are you going to have in retirement? Guys, if you retire at 62 to 65, in 30 or 40 years from now, 20 years from now, you're going to live 25 or 30 more years in all likelihood. So you got to make sure your money lasts that much longer. And I'm going to show you how much that 1% fee affects you over time, because it's really, really important to understand that. But as you've seen, what's most important in this, when we put our annualized returns, it's over a long period of time. In that time, I showed you the chart, how many things are going to be good or bad. You're going to feel euphoric at times. You're going to feel crappy at times. But the best investments were made during the worst times. When the outlook was the worst, that's when you had the best opportunity. And it makes sense. When outlook is bad, prices fall because nobody wants to own those things. It takes that strength as an ETF owner to keep buying, as a stock owner to keep buying that stock that has negative news around it because you understand the fundamentals. Investing is so difficult emotionally. It can be a lonely road. That's what makes it so hard. The fundamentals, the numbers are the easy part. I used to think investing was 90% numbers, 10% emotion. No, it's 90% emotion, 10% numbers. And so I'm here trying to teach that process of fundamentals, but more importantly, trying to help you manage your emotions better. That's why I created the community and the software, was to be able to help people manage their emotions. So if you want to make less emotional decisions and therefore more money, sign up the link, click the link below, join our community. Guys, there's a wait list now. There's only X amount of spots available per day. So when you click that link right now, if there's spots available, sign up. You can try it out for $7 for 7 days. It is a no-brainer. Sign up now, click the link, avoid the wait list. And trust me when I say, if you're able to learn the emotional side of the game, you will do so incredibly well. And thousands of investors can help you do that every single day. So based on this retirement calculator, let's put some assumptions in. Let's say you're 35 years of age. You're going to retire at 65. So that gives you 30 more years to retirement. And let's say your current savings is $250,000. And guys, I don't know if this is right or wrong, but just roll with me here. The point of this is to show you how costly it is to pay those mutual fund fees. Now, let's say your annual savings are $15,000 a year, and you're going to increase that by 4% a year. Now, if you invest in an ETF and just get the market return of 9% per year, and during retirement, you go a little more conservative and you get 6% a year. And you live to the age of 90 with inflation at 3.5%. And your current income is $100,000 a year in today's taxes, today's dollars before taxes. And when you retire, a lot of people, I used to put 100% of your income, but studies have shown time and time again, people spend less in retirement. So let's say you're going to spend 80% of your income. Hit the generate button. First off, do you have enough for retirement? Congratulations. Yes, you do. Okay, so if your numbers are like this, you're probably okay. If your numbers are better, even better. But let's look at this. When you hit retirement, it's age 65, you're going to have $6.9 million in retirement, which is equivalent to $2.5 million today. That's another thing we do different. We show today's dollars on your retirement level. So $7 million you're going to have in retirement. And when you pass away at 95, good news, 11.9 million bucks. That's incredible. You're going to keep growing your wealth. Now, let's do one small thing. Let's change that annualized returns. Remember, they do worse in returns. 82% of mutual funds do not outperform the market. And over a 10-year period, it's something like 3% do it. So you're not going to beat the market. So let's say you lose by 0.5% a year and you pay a 1% fee. That's 1.5% loss there. Take your 9% to 7.5%. Take your 6%, conservatively down to 5%. Hit the generate button. Good news. You still have enough in retirement. You still had enough, but you have enough because of you. Let's see how much you have at age 65. In the previous example, it was $6.9 million. You now have $4.9 million. That actively managed fund costs you $2 million in retirement. $2 million. And instead of $11.6 million, when you die, you have $880,000. You lost $11 million due to mutual fund fees. Is that worth it? Is it worth it to have some Harvard egotistical maniac who can't handle his emotions managing your money? Now, going back to stocks, my main goal here is price versus value. Your goal is to buy value for less money. So when value exceeds price, you want to buy it. Now, a lot of people say, Paul, I'm not a value investor, I'm a growth investor. No, there's no such thing as a difference between the two. You're an investor, and every investor's goal is to buy $1 for less than $1. Because if you're not going to try to do that, just invest in an ETF. You're going to do great. You don't need any more money. Now, you might sit there and say, no, Paul, growth investing and value investing is different. No, value investing isn't about buying a piece of crap for a lot less money. It's about valuing a company today. And that's why we use our stock analyzer tool here. You value the company today. But look at this. What's the very first line? Revenue growth. And it's going to give you a value based on revenue growth being 2% or 20% a year. That value today is that value. No matter whether it's 3% a year or 30% a year, that's the value. And your goal is to buy it for a cheaper price. So when I hear people say like, oh, I'm a growth investor. Listen, you're an investor or you're not an investor. An investor's job is to try to buy $1 for less than $1. And that dollar can be calculated in multiple ways. There's revenue growth, there's profit margin, there's free cash flow margin, there's PE, there's price to free cash flow, and then your desired return. What's your desired return? You might sit there and say, Paul, you know what? I don't know if I like this company. I'm not willing to do a lot of research. I need to make 15% of my money. Great. Somebody else might sit there and say, no, I know the company inside and out. I'm fine making 11%. Awesome. Every investor is different. There's no carte blanche way of investing, but it's about understanding it for yourself. But there is no difference between growth and value investing. There's just investing. I think every investor naturally is a value investor because they're trying to buy $1 for less than $1. Now, the younger, more risky might need to buy the $1 for 50 cents. But something like Coca-Cola, an established company, or Microsoft, an established company, you might be okay buying $1 for 90 cents because it's a much more stable revenue and profit center. And that's what's so important to understand. Guys, investing is simple but not easy. And hopefully this video has provided you some sort of glimpse into how you can handle it, whether you want stocks only, ETFs only, or a combination of both. My own cousin, who was just messaging me earlier, great guy, member of the community, he said, Paul, I have 95% of my money in ETFs and I have 2 stocks. Awesome. Good for you. That's what works for him. And if over time he gets more confident in buying stocks, he might buy more. I was 100% ETFs just 20 years ago. Then over time, I started to buy more individual companies. So guys, if your path is more along the ETF, watch this next video that pops up on the one ETF you need to own forever. And if your path is more about stocks you want to own, watch my next video on the 33 companies I want to own forever. I'll see you in the community, $7 for 7 days. Click the link below.